Hello and welcome back to Simple Money, the show where we look at important personal finance issues in short and fun episodes. I'm your host, Matthew Seawick, also known as the Friendly Financial Coach. Today, we finish our income tax series by focusing on 3 random, non-refundable tax credits. So, for those of you that don't remember, a tax credit essentially reduces the amount of taxes that you have to pay. So, trying to find as many tax credits as you can when you do your taxes is definitely a great way of saving money. Today, we'll be looking at the medical, tuition, and ill-fated transit tax credit. So starting with the medical tax credit, this one is a little bit odd, as there are a lot of small details and ways that you could actually maximize how much you receive. So you're able to claim medical costs for a lot of different purposes under this tax credit. This includes expenses related to doctors, dentists, certain medical procedures, certain medication, medical care, and more. The CRA provides a consistently updated list of what is and what cannot be included in this tax credit. This list can be accessed by anyone. So the amount that you can claim is any amount that is out of pocket. So if a portion is reimbursed by any healthcare plans or for any other reason, then it's not eligible. The amount that can be claimed is the excess amount over the lesser of $2,268 or 3% of your net income in 2017. This amount also mildly varies by province, but is roughly similar to the federal amount. So there's actually a lot of insider tips with how to maximize this tax credit. First of all, since the credit can be shared between spouses and dependent children, it's best if one spouse compiles all of these expenses and then claims it on their tax return. Typically, you'd want the lower income spouse to claim the medical expenses because their minimum threshold is often lower. Also, you can claim the expenses for any 12-month period. It doesn't just need to be a calendar year. So what you can do is you can pick a 12-month period that really maximizes the amount of expenses that you paid for your medical costs. So moving on, next up is a big one, and it's the tuition tax credit. This tax credit is a percentage of the amount that is paid for eligible post-secondary costs. Certain occupational, trade, or professional examination fees may also be eligible. This non-refundable tax credit can also be passed to a spouse, parent, and even in some cases, a grandparent. So if you're not able to use any portions of your tuition tax credit, then you can actually carry it forward to future years and claim it against your future income. As a side note, some other related tax credits have actually been canceled. Specifically, the education and textbook tax credits have been eliminated in 2017. So next up is the ill-fated public transit tax credit. This is basically a eulogy for this tax credit because it's been canceled. The good news is that you can still claim it for part of 2017. So all eligible public transit passes can be claimed from January to the end of June 2017. Beyond that, you don't get any tax credits for it. That's it for today, and also the end of our income tax series. I hope that you're able to save some money for the information that we shared. If you have any questions, you can contact me on Twitter at ffcoach, or you can email me directly at info@ffcoach.ca. Hope that you have a great week. Talk to you soon.